Another day, another story. In the realm of finance, pledge and mortgage are common mechanisms used to secure loans and protect the interests of lenders. While both involve providing collateral for a loan, they differ in terms of the assets involved and the rights granted to the lender. We will discuss the details of pledge and mortgage, highlighting their key differences, and providing examples to illustrate their application in various scenarios. Pledge is a financial arrangement where a borrower pledges specific movable assets as collateral for a loan. These assets can include tangible items like jewelry, stocks, bonds, or any other valuable property that can be easily transferred to the lender in case of default. The borrower retains ownership and possession of the assets but provides a security interest to the lender. If the borrower fails to repay the loan, the lender has the right to seize and sell the pledged assets to recover the outstanding debt. Example: suppose an individual borrows money from a bank and pledges their investment portfolio as collateral. In this case, the borrower maintains ownership and control of the investments, but in the event of default, the bank has the right to liquidate the investments to recover the loan amount. Mortgage. A deeper dive on the other hand, a mortgage is a financial arrangement involving immovable property such as land, buildings, or real estate. In a mortgage, the borrower transfers the title or ownership of the property to the lender as security for the loan. The borrower retains possession and usage rights of the property, but the lender holds the legal title until the loan is fully repaid. If the borrower defaults, the lender has the right to initiate foreclosure proceedings to sell the property and recover the outstanding debt. Example: consider a homebuyer who obtains a mortgage loan from a bank to purchase a house. The bank provides the funds, and in return, the buyer grants a mortgage on the property. The buyer has the right to live in and use the property, but if they fail to make timely mortgage payments, the bank can foreclose on the property and sell it to recover the outstanding loan balance. Key differences are: assets involved. Pledge involves movable assets such as stocks, jewelry, or other valuable possessions. In contrast, mortgage involves immovable assets, typically real estate or land. Ownership and possession. In a pledge, the borrower retains ownership and possession of the pledged assets. In a mortgage, ownership of the property is transferred to the lender, but the borrower retains possession and usage rights. Default and remedies. In case of default, the lender in a pledge can seize and sell the pledged assets to recover the debt. In a mortgage, the lender can initiate foreclosure proceedings to sell the property and recover the outstanding loan balance. Registration and documentation. Pledge transactions usually require less formalities and documentation compared to mortgages, which often involve extensive legal processes, title searches, and registration with relevant authorities. Transfer of title. A pledge does not involve the transfer of title to the lender, whereas a mortgage involves the transfer of legal title until the loan is repaid. Pledge and mortgage are distinct mechanisms used in financing to secure loans and protect the interests of lenders. Pledge involves movable assets, where the borrower retains ownership and possession, while mortgage involves immovable property, with the lender holding the legal title. Whether it's pledging valuable assets or mortgaging real estate, these mechanisms play crucial roles in the world of finance and provide security for loans in various contexts. Thanks for watching.